Income after death can land in three places: the decedent's final Form 1040, the estate's Form 1041, or the beneficiary's Form 1040. The exam trick is timing and who actually receives the cash. If it was earned before death but paid after death, you should immediately think IRD. If it's earned after death during administration, that's estate income on Form 1041 unless distributed out. Income in respect of a decedent, IRD, is taxable income the person earned but didn't receive before death. It does not go on the final 1040. Instead, it's reported by whoever receives it, the estate on Form 1041, or a beneficiary on their own return. On the EA exam, they love the phrase, "who receives it," because that's the reporting trigger. Common IRD items are very practical: unpaid wages or bonuses, accounts receivable from a self-employed person, accrued interest, dividends declared before death but paid after, rent owed but not yet paid, and retirement plan distributions that were due. Quick exam move: if the decedent already did the work or already sold the asset, but the check arrives later, you're in IRD territory. IRD keeps its character. Ordinary income stays ordinary, capital gain stays capital gain, and tax-exempt interest stays tax-exempt. That's why a beneficiary might report both wages-type IRD and a capital gain IRD in the same year. Two nuances they test: wages paid after the year of death generally aren't subject to federal income tax withholding, and accounts receivable is IRD but not subject to self-employment tax. Now layer in NIIT. Estates and many trusts can owe the 3.8% net investment income tax calculated on Form 8960. For estates, it generally hits undistributed investment income once the estate's AGI exceeds the threshold where the highest bracket begins. Translation: estates reach the top bracket fast, so holding investment income inside the estate can trigger NIIT quickly. Grantor trusts and tax-exempt trusts are generally out. DNI and the income distribution deduction are the anti-double tax rules. An estate or trust is a hybrid pass-through. Income is taxed either to the entity or to beneficiaries, but not both. DNI is basically the cap on how much taxable income can carry out to beneficiaries. The estate gets an IDD for amounts paid, credited, or required to be distributed, shifting taxation to the beneficiaries. Harrington died on April 10th. After his death, his brother Ethan receives the following IRD items: unpaid wages of $13,500, rental income owed at death of $1,000, municipal bond interest of $750, and a $1,000 short-term capital gain from stock Harrington sold before death. How much taxable income must Ethan recognize, and what's the nature of that income? Think about it. The correct answer is $14,500 of ordinary income and $1,000 of short-term capital gain. IRD is taxed to whoever receives it, and it keeps its character. So wages plus rent are ordinary income. The stock sale stays short-term capital gain. The tempting wrong move is to include the $750 of muni interest, but tax-exempt interest stays tax-exempt, even as IRD. The Whitaker Family Trust must distribute all income annually. It has $30,000 of tax-exempt interest, $75,000 of taxable interest, and a $15,000 fiduciary fee. Half of the fiduciary fee is allocated to the tax-exempt interest. After allowable expenses, how much taxable income passes through to the beneficiaries? Think about it. The correct answer is $67,500. You allocate the fiduciary fee between taxable and tax-exempt income. If $7,500 of the fee is allocated to tax-exempt interest, only the remaining $7,500 reduces taxable interest. So, taxable interest of $75,000 minus $7,500 equals $67,500 passing through. The tempting wrong answer is $75,000, forgetting the allocation rule.